Good evening and welcome to Boston University's Real Estate Club Guest Speaker Series for conversations about real estate leadership management and people who have achieved something in our society. Ken Bernstein is certainly that. He's the co-founder, president, and CEO of Acadia Realty Trust. Acadia specializes in the acquisition, redevelopment, and management of open-air retail properties across the United States. Outside of Acadia, Ken also serves as a 2021 ULI Global Governing Trustee and is a member of the Board of Trustees at Golub Capital. I'm pleased to welcome to this virtual room, Ken Bernstein. Good to have you here, Ken.
Good to be here. Thanks for having me.
You received your bachelor's from the University of Vermont and your JD from Boston University School of Law. When and how did you realize your passion for real estate?
And it wasn't a direct line, meaning when I went to law school, I thought I was going to be a corporate attorney, mergers, acquisitions. I was fortunate to go spend a summer as a summer intern at a law firm that had a very dynamic real estate practice. The head of the real estate department was very charismatic. I had a chance to spend some time with him. And then it just evolved. Real estate from a legal perspective is a fascinating way to practice law. And once I started doing that, I realized I also had a passion for being on the business side. The other thing I'd say is, as a kid, I started a lot of small businesses, just like many of you probably did, to make a buck over the summers or otherwise. And so I knew I had a passion for business in general.
Thanks, Ken. Really appreciate it. Let's shift that passion right into the inception of Acadia, which now owns or has ownership interests in over 100 properties, totaling approximately $3.5 billion in value. Can you tell us the story behind co-founding the company and take us through its journey of growth over the last 23 years? Please do focus on the beginning as well, though. You know, a lot of us are entrepreneurial ourselves.
Yeah, so when I was at BU, and law school's a pain in the neck, but BU was a great law school. The best part about it was I met and married my law school sweetheart. I started practicing law in 1986, and in 1990, Janet graduated a few years after I did. 2 lawyers in one family was at least one too many. And I realized I wanted to go start out on the real estate and the business side of it. In 1990, for those of you who might remember in the history books, was one of those periods of severe correction in the real estate industry. So I knew enough that I was getting in at a period of distress. I joined a client of the firm who was just starting up his business. And from 1990 to 1998, we grew that business from a few shopping centers to, in 1998, we took the company public in a reverse merger takeover. And that was kind of the next step. From that point, there were several cycles beyond it, and I could get into all of it. But in general, it was just understanding I knew I wanted to be on the principal side. I knew I wanted to be an investor and operator of real estate. And as the opportunities to go public or other decisions came up, we took advantage of that.
Really appreciate it, Ken. And before we move to present day, what would you say the greatest challenges were at the time when starting the company, and how did you overcome some of those challenges?
Yeah, every day it's a challenge, right? So when I started in the early 90s, the real estate market was a mess. Now, we weren't going through a global pandemic, but for a bunch of the financial institutions, it was a scary time. Having the confidence to continue through, having the certitude to manage a team who at different times were very scared or distracted, and having the humility to realize, boy, things are changing, we got to change with it, enables a level of flexibility so that you can manage through the crisis. Then things get better, and you need to make sure you're ready to go on offense, because When things get better, you got to take advantage of those opportunities. That kind of pivot. So 1990 was horrible. 91 was really tough. By 92, it was time to go on offense. And thankfully, we were able to do that. And then in the late 90s, we had a correction and the dot-com bubble. So there's plenty of ups and downs. If you don't like cycles, don't be a real estate investor, because it's a cyclical business and you just got to get used to that.
Well said. Thanks, Ken. Let's bring it back to present day now. Just to set the tone for the next couple of questions, would you be kind enough to explain Acadia's platform to some of our members?
Yes, and this is a little complicated. For those of you who are freshmen in college, you have years to figure this all out, but we operate, and how Acadia is different than most of the other publicly traded REITs is we operate under what we call a dual platform. We can access and raise capital in the public markets, and we do that. But many years ago, around 2001, I realized I didn't want to be solely beholden to the public markets, because any of you who trade stocks know there's good days and bad days. Today was a bad day. The good days outnumber the bad days, but I didn't want to be solely beholden to the public markets. So we also have a series of funds backed by institutional investors, university endowments, foundations. I joke it's the endowments that didn't let me into their college or law school, but a bunch of the major Ivies. And so having a real estate private equity arm gives us the opportunity to invest even if the stock market is not open for business.
Thanks, Ken. Really appreciate it. And let's talk a little bit about the digital aspect here, knowing that you guys are in the retail space. How is Acadia responding to digitally native retailers?
We are embracing them, and we have from a early point in the digitally native history. So let me explain. First of all, Acadia owns a significant amount of its portfolio is street and urban retail. Think Soho, M Street in Georgetown, a little bit in Newbury Street, San Francisco, Los Angeles, Melrose Place, things like that. So we are very dependent on both luxury retailers and then hot and upcoming brands. And the digitally native were certainly that. Warby Parker, who I think just went public today, Allbirds, and a variety of other retailers like that have been tenants of ours since they started opening stores. Here's the good news from a real estate investor's perspective. These digitally native brands have done an unbelievable job of building a business online, but almost all of them now recognize that a critical channel, a critical component of their business is their physical store. In fact, Warby Parker projects that the majority of their sales are going to come through stores. And on top of that, when you look at the cost of customer acquisition, the cost that a digitally native retailer has to pay Facebook or Google or whatever other search site is, compared to the cost of rent that they pay us, what many of them are figuring out is it's very important as they build their business to have those stores. So I don't worry about them at all anymore. Certainly online sales have been a multi-year headwind for a host of retailers, but now I would tell you for a large chunk of the retailers, embracing the digitally native is critical. You're seeing that from tenants ranging from Target all the way down to the digitally native, and then from us as a landlord, same thing. So I think you're going to see going forward, this is good news for us as owners of that kind of real estate as opposed to a challenge.
Another growing trend is the idea of ESG. How ingrained are ESG principles in Acadia's operations and culture?
So a few thoughts around that. First of all, it's a work in progress, and I think it's going to be a multi-year work in progress and will continue long after I'm retired. The other thing is ESG if you really break it down, is three very separate components that are somewhat or very different. And we're using it and putting it all together, but it's like putting pasta, chocolate, and I don't know, grapefruit, and saying that's a meal. No, you may like all three, but they're very different. So E is the environmental, S is the social, meaning diversity and inclusion, and G is governance. You mentioned digitally native. Virtually every tech company that goes public has two classes of stock, and I would argue that immediately disqualifies them from having, quote, good governance. Good governance, especially in the public side, means being as transparent and fair to the shareholders as possible. And I'm not judging them. There's reasons to have two classes of stock, but the mission around governance feels so different than the mission around climate change or the mission around diversity. We all lump it together, but I would suggest to you, governance is important. It's table stakes, meaning you better have good governance if you want to raise capital, if you want to be a fiduciary. But let's talk about the tough ones. Climate change. From our perspective as a landlord, a decade ago, if we would push our retailers, so realize if we own a shopping center, imagine that shopping center that you do your grocery shopping in, or a shop on Newbury Street, if we told the tenants, here's what you need to do, they'd say, this is our store, we'll manage it the way we want. The refrigerators in our grocery store are our concern, not yours. We're only beginning to figure out how to bring this all together. So you will see solar panels, you will see other initiatives that landlords can do. But what I think will get and be the most exciting on the environmental side, and for all of us to get carbon neutral, will be landlords and tenants, municipalities, all working together. And that's in front of us. I'd say that's a multi-year process. And diversity and inclusion, I take a lot of pride in how Acadia has advanced itself, but when I look at my Zoom screen now, my company does not yet look like everybody here on this call. And I'd argue we even have room for improvement in terms of diversity on this call. So it will happen because we as companies do what we can. We have a robust summer internship program, and I urge my team to make sure that the diversity there is real and appropriate so that we can reflect who our future shoppers will be, who our future team members will be. That's also going to take time. It's going to take hard work. We're trying to do it, but I'm not about to give us an A yet. We got a lot of work ahead of us.
Thank you. Let's talk about this concept a little bit more, but with your actual assets now. How does your ESG criteria impact investment decisions and portfolio construction for the company?
Again, let's stop calling it ESG. Let's just call it straight up environmental, if that's what you mean.
Yeah.
Right. And there's two ways to think about this. It's what can we do with an existing asset, an existing building somewhere in the United States, to make it more environmentally, more carbon neutral. And there's a lot. If you've seen the roofs of shopping centers, and they're usually black, and that's horrible. So green roofs, solar, better transportation, and the list goes on. But I'll point out better transportation during COVID. We got to get people back on subways and trains and buses and mass transportation. In New York City, for instance, the roads are already back to pre-pandemic levels and the trains are still empty. So some of that is up to me. Some of that is up to all of us, but we need to do whatever we can on that side of environmental. The other side, and we could spend the rest of tonight's call on this. Only recently have investors started to say, geez, it's getting hotter, it's getting drier or wetter. well, how are we thinking about floods? How are we thinking about forest fires? Is there a risk that 5 years from now, that property that you are about to buy or have just bought might not be an investable asset? And so, sure, we talked about the issues of e-commerce. Good news is I am much less concerned about the risks of e-commerce today than I was 2, 4, 5 years ago. But I'm more concerned about the impact of climate, the lack of water or too much in various parts of the United States. So we're also thinking about it long and hard from that perspective, because we can't solve this by ourselves. We're not going to, but we certainly should not be making investments in places that may not be sustainable.
Thank you. Let's shift focus to something that we're all, experiencing as well on top of climate change, which is this COVID-19 pandemic. We're now, I'd say, 1+ years into this pandemic. How has this impacted the REIT sector, your current portfolio, and how has Acadia pivoted in the last year as a result?
So, first of all, this is a health crisis of unbelievable proportion when you consider the number of deaths. It's a crisis for families. We have a host of young parents of young children and what they're dealing with now, what they dealt with over the past year, or dealing with multi-generational families. So first and foremost, this is a health crisis. This is a health crisis we will get past, but unfortunately, as Delta has told us, we're not going to get past this as easily as we perhaps thought even 6 months ago. We are doing what we can to educate our team, to educate our members. I urge all of you, I know at your age you think you're invincible. I hope you are, but you probably are not. And even if you are, I assure you, your parents are not. So please, please, please get vaccinated. You would think that's easy. I assume most of you are. The level of vaccine hesitancy is very concerning to me. It's one of the many challenges that we have as a company. We have worked through it and successfully. Our team is vaccinated, but that is part of the challenge. Let's now talk about the real estate side. When our stores were forced to close, half of our tenants were not able or refused to pay us rent. Most of our tenants are national, multi-billion-dollar companies. So this was a unique period of time where they could afford to pay rent, but they didn't. And some of our tenants are mom and pop retailers, local merchants, their life savings are in their stores, and certainly they also had an issue. The good news is now, virtually all our stores are open. Virtually all our tenants are paying. And here's the interesting part. I've been through many cycles. This is the first cycle that we have climbed out of, that the consumer is healthier today than before the crisis. Now, there are a lot of exceptions and they're heart-wrenching. But in general, consumer savings rate is up, house values up, stock portfolios up, and thus spending is pretty robust. Whether you want to call it revenge spending, people tired of being locked away, or just pent-up demand, or healthy balance sheets on the consumer, good news is people are coming back. They're shopping not just for toilet paper, not just for necessities, but for a variety of items. And that bodes pretty well for portfolios like ours. So point number one, health crisis, we got to get through it. Point number two, the shoppers are back and the retailers are getting in front of that. Final piece, and I don't have an answer for this, the way you all are going to work is going to change. We need to be prepared for that. But I'd caution you, don't buy into this remote work forever as a likely outcome. If you were asking me for advice, I'd say be prepared to follow the old rule, be in the office before your boss gets there, leave after she does, and If it evolves, if it changes, and it will somewhat, if there's hybrid, fine. But roll up your sleeves if you want to be in the real estate business and be in it to win it, not be in it to be on a beach in Maui. Although Maui sounds interesting.
Thank you. To wrap up this segment, let's kind of shift focus away from Acadia and talk a little bit about yourself and some maybe general advice for our audience members. What are the professional achievements of which you're the proudest of or which have marked you the most? And what are some of the lessons you've retained in relation to these achievements?
So let's start with the lessons. I touched on a bunch of cycles, early 90s, late 90s. Then we had the global financial crisis in 2008, 9, 10, and now a global pandemic. You kind of get that rhythm each time. Someone said this was a once in 100-year event, but they seem to show up every decade or so. Don't set your watch by it, but be prepared for the unexpected. And 100-year floods, one way or another, seem to show up about every 10 years. And if you do not have a company, a platform, if you don't have the personal ability, resilience to deal with that, as I said earlier, a cyclical business like real estate is probably not going to be fun and rewarding. So expect the unexpected. What I learned or what I appreciate of what few things Acadia has achieved is that we did it with a high level of integrity. We did it our way. We didn't just follow the herd. In fact, we've been fairly to very contrarian, but we had a few core principles, a few core values, and we've stuck to them. Doesn't mean every one of our investments has been great. Doesn't mean that our stock price goes up every day or 100 other issues. But what it does mean is our reputation, mine personally, and I hope my company's, is that we do what we say, we're thoughtful about it, we're fair, we fight like heck, but we do it with intensity, integrity, intelligence, and innovation, which are our 4 I's and our core values.
Well said. Thanks, Ken. And when looking at some of your most accomplished current and past colleagues, do you see any common characteristics amongst them? If so, could you maybe talk a little bit about this?
So here's the good news. I see absolutely none. Meaning our industry perhaps, but I'd just say life in general, a whole bunch of different types of people can be unbelievably successful. Some are introverts, some are extroverts. Some are unbelievably creative and others are just very disciplined. Ideally, if I was giving advice to college students, I'd say, work on your weak points now, but you don't have to be just like me or just like anybody else. You can figure out what works for you. And as long as you do it with conviction and as long as you're good at it, there's a lot of room for excellence in our country. We're certainly going through a tough time period, but I still believe it's the greatest country in the world. And there are so many different ways that you can rise up that ladder.
I think the last question I'd love to include, this is a really general one for all our audience members who are young and ambitious, whether they want to go the corporate route or the entrepreneurial route. And I want to kind of steer away with this answer from maybe the topics we discussed tonight. But what advice would you give someone who's looking to build a career in real estate, maybe young, maybe in college, just starting out, or even going to pivot in their young professional career?
So short answer is be prepared to pay your dues. I chose to do it through the law. It was a grind. I have no regrets. One way or another, there will always be shortcuts offered to you. They are tempting. I am not telling you not to pursue shortcuts periodically, but be prepared to pay your dues in our industry or any cyclical industry, but I think it's true across the board. The tide will go out. There will be tough times. And if you have learned your trade, if you are good at what you have done, there will be other opportunities. If all you did was try to chase the fast dollar, the easy way out, if you didn't achieve a level of excellence, a level of appreciation of your reputation amongst your colleagues, then it's that much harder. Now, that being said, there are probably billionaires right now who contradict everything I just said. And then I'd go back to what I said before, which is there's a whole bunch of different ways to succeed. But my advice is roll up your sleeves. If you're interested in real estate, especially, roll up your sleeves, learn the business from whichever avenue you enter it, whether it's leasing or finance or construction or development or the law. Learn it, and then you can move on up the ladder.
So now I think let's open up the floor, right? We have a lot of members on the Zoom, and I bet they're all eager to ask some questions.
What I've learned over time is not to try to predict, especially interest rates. So I'm hoping there's more questions, but not where are interest rates going. And then even things like a recession, because often the risks that hit are external and things that we haven't thought about. Or we may have thought about, but I don't know how you think about or gauge what North Korea might do or might not do, and could that create a recession? And something could. Here's the good news, and then here's what I'm watching. The good news is, as I said, the consumer's in good shape. Our fiscal and monetary intervention this last go round was so much stronger. And I'm not getting into the politics of the moment, but just over the last 12, 24 months, the intervention was so much more significant than what happened during the global financial crisis or other times that I think we're in pretty good shape. Now, if we have a government shutdown, that could be a problem, and I could think of 100 other problems. But overall, I think we're in pretty good shape. The job market is unbelievable. If you listen carefully, the biggest problem right now is supply chain issues, but one of the big supply chain problems is people can't find enough people to work, even with wages rising considerably, especially at the starting level. So assuming that the supply chain gets fixed in the next 12 to 24 months, and it looks like it will, assuming that the job market remains strong, although probably not as strong as it is right now, I feel pretty good for the foreseeable future on that side. Interest rates are going to go up, but it looks like we are pretty well set, provided that we're not talking about variance and on a regular basis, provided that what is a global pandemic now becomes an endemic. I think that feels pretty good. Here's what I would watch for, though. We started talking about digitally native. It is shocking to me the number of companies, either through SPACs, IPOs, or private equity. There's so much money out there. How many companies are worth billions of dollars and do not make a profit? That can last for a very long time. That can last until it doesn't. But that's when you read about the dot-com bubble that occurred before many of you were born, but in 1999, 2000, that very different time for technology. And I am not predicting another tech bubble bursting, but the problem there was, again, the fundamentals didn't make sense. So I'm watching that piece of it. So far, it's not at a level where I'd say I'm concerned, but that's one of the events you ought to keep your eyes on, because if we start seeing things, those bubbles bursting, then that could lead to a recession. Yeah, so I am much more optimistic than I was a few months ago. If you look at the residential rental market, your friends who are a few years older than you and got 3 months free rent a year ago, and my son is one of those. And they were able to move into great apartments. There was significant residential rental vacancy. And now that market has already rebounded. So the first good sign is young, energetic professionals are moving back to New York City. The bad news is you can't get any great deals renting an apartment. But that's one sliver of an economy. You need to address workforce, you need to address crime, you need to address mass transportation. And from my perspective, owning retail real estate, we need to see international tourism come back. We need to see Broadway reopen. We need to see restaurants fully revived. So I don't want to pretend that it's all done right now, but I see the signs. I would tell you that compared to a year ago, it is pretty clear to me that places like Soho are going to bounce back and bounce back strong. Other parts of the city may take a little bit longer, but provided we can get past this health crisis, provided that the elected officials and everybody else in New York City gets their act together, which is a risk, but again, I'm feeling pretty good about that. I think New York's in pretty good shape. So we launched our fund around 2000, 2001, when frankly, if we did not do that, if we did not have access to those institutional investors, I don't think Acadia would have survived. I don't think we could have differentiated ourselves and made a case why you should buy our stock versus other good companies out there. And I felt like it was a way to differentiate ourselves 2001 until the global financial crisis. At that point, man, it was painful across the board. But what I can tell you is because of our private equity business, we were able to go back on offense and start buying properties much sooner than if we were just waiting for our stock to recover. So it was helpful there. It has been a fun, exciting way to run our business. So along with buying properties for the long haul. So in our REIT on balance sheet, we're buying properties that we're counting on them appreciating over the next 5, 10, 20, 30 years. In the private equity side, we're really thinking over the next 1, 3, 5, 7 years. And we're thinking in a much broader spectrum. So we not only bought real estate directly, but we're part of the group that bought Mervyn's department stores and re-tenanted those, very successful investment. Part of the group that owns Albertsons supermarkets. That we could not have done as easily in the public market. So it helps during the cycles, but it also just makes life interesting because we can do a wider array of transactions. So short answer is I don't know, right? The notion that Evergrande will be China's Lehman Brothers, I think, is what everyone's wondering. And they're like, no, it probably won't be. It's so hard to know early on. You have a company in a country that seems to have a lot of control over their banking, over a variety of other components of their economy in ways that are different than the United States. So you would expect that the Chinese government can intervene, and this will not be a problem. That's the most likely outcome. But a company with that amount of debt, of that size, is something we ought to take notice of. And what I would remind all of us is, if we were talking in 2007, 8, 9, long before Lehman Brothers failed in September, 6 months prior to that, it was Bear Stearns. And your question would have been, do I think that Bear Stearns would be a contagion that could impact Wall Street? And my answer would have been wrong. And I would have said, no, that looks like it's really isolated to some bad trading decisions, that this is really a crisis in the subprime residential real estate component, and everything else should be fine. And 6 months later, you would have said, Ken, I went to work for Lehman Brothers, you were wrong, and I want my money back. So let's assume that this is isolated to China. Let's assume that it is resolved within China. But every month or so, watch it, and if it looks like it's contagion, you'll begin to see the signs.
Anyone else? Going once, going twice. Ken, you're looking like a free man. I think this is pretty good. I'll let you run, but Ken, truly, it's been an absolute pleasure having you tonight. We couldn't thank you enough for coming and joining us. We learned a lot, and we hope to see you again someday. So thanks again, Ken. Really appreciate it.
All right. Well, it was fun. Nice to meet all of you, and good luck on your journey.